Welcome to Iron Financial, the only place we forge stronger portfolios by cutting right through market weakness. Today we are putting LKQ Corporation on the anvil. They just dropped their earnings report, and to put it lightly, the market absolutely hated it. The stock got hammered before the opening bell even rang.
Hated it? They dragged it out back and beat it with a stick. So the real question is, are we here sifting through the wreckage for scrap metal, or is there actually some high-grade steel left in this company's frame?
That is precisely the job. See, when the market panics, that's when we get to work. Our mission today is to figure out if LKQ is a total teardown or if it's a solid structure with a strong foundation that's just in need of a serious renovation. Let's get right into it.
All right, let's start with a punch to the gut. This was the very first number traders and algorithms saw flashing on their screens. A drop of more than 5.5% in the pre-market. That is a brutal, almost primal reaction. It tells you that whatever the headline was, it triggered an immediate, no-questions-asked flight for the exits.
And why not? A 5.5% haircut before you've even had your first cup of coffee is what we call a falling knife. And you know the first rule of falling knives: don't try to catch them. Most sane investors are just going to step back and let that thing hit the floor. So you're going to have to show me something incredibly solid to convince me this isn't just a trap for bargain hunters about to get their hands sliced off.
And that is the mission for us today. The market often reacts to surface-level damage. It sees a chip in the paint, a crack in the plaster, and it immediately assumes the whole building is about to collapse. Our job here at Iron Financial is to act as the structural engineers. We're going to ignore the cosmetic stuff for a minute, and we're going straight to the foundation. We're going to check the load-bearing walls, we're going to inspect the plumbing, the electrical. We are here to find out if this company is built on solid iron or if it's just sitting on a pile of sand.
Fine, I'm on board for the inspection, but I'll tell you this. If we find termites chewing on that foundation, we're calling the exterminator, not a contractor.
So let's see the plan of attack. All right, here's our structural inspection plan for today. First up, we're going to examine the headline shockwave. We need to know what exactly caused the initial panic. Then we move on to inspecting the numbers, where we look past that cracked facade. Third, and this is crucial, we're testing the core of the building, the cash flow engine. After that, we'll look at management's new blueprint to see their plan for the renovation. Then we'll scrutinize their 2026 outlook. That's the contractor's forecast. And finally, we will deliver the Iron Financial verdict. Is this a rebuild or is it ruin?
Okay, phase one of the inspection. We have to understand what spooked the herd so badly. What were the specific headline numbers that sent investors scrambling for the exits? This is where the first cracks appeared in the wall. So let's get up close and see how deep they really are. And here we have Exhibit A, the earnings per share or EPS miss. Wall Street, with all its fancy models and projections, was looking for 64 cents a share in profit. LKQ came in and delivered 59 cents. That is a 7.81% negative surprise. Now, in the high-stakes world of quarterly earnings, that is not a rounding error. That's a clear, undeniable miss that immediately sours the mood and forces big institutional funds to rethink their entire thesis on the stock. This was the very first domino to fall.
You can't dress it up. A mess is a mess. These analysts are paid fortunes to get these numbers right, or at least close, and the company couldn't even clear that bar? That alone is a pretty bright red flag. But this isn't even the worst part, is it? It gets a lot uglier.
Exactly. And this is the gut punch. This isn't just about missing an analyst's guess. This is about the actual direction the business is heading. We are talking about a massive 24.4% drop in adjusted earnings per share compared to the exact same time last year. They went from earning 78 cents down to 59. This isn't just a stumble. This is like falling down an entire flight of stairs. Profitability is eroding, and it's eroding fast. This is the first major structural crack in the facade. And believe me, it is a deep one. To me, this screams that the core business is getting fundamentally weaker.
And you're not wrong to point that out. That is a significant decline, and it's the absolute core of the bear thesis. No one can or should just ignore a 24% drop in profitability. It's serious.
And that profitability problem is absolutely undeniable. The market saw it, they punished the stock for it, and frankly, a lot of people just closed the book and moved on. But our job is to keep digging. If this was just a simple story of declining profits, well, we'd end the analysis right here. But it's not that simple. So let's move to the next phase of our inspection and start looking beyond those initial ugly cracks.
And here's where the story gets interesting. This is a crucial piece of the puzzle. While everyone was fixated on the earnings miss, they completely glossed over the revenue beat. The street was looking for $3.25 billion in sales. LKQ actually brought in $3.31 billion. Now that's a 1.85% beat, but more importantly, it represents 2.7% growth compared to last year, and it was driven by real strength in their North American wholesale business. So let me ask the obvious question. How is a company with a supposedly fundamental demand problem actually growing its top line and beating expectations? Whoa, hold on a second. Revenue is vanity, profit is sanity. We all know that. For all we know, they could be selling dollars for 90 cents just to hit a sales number. Beating a revenue target by less than 2% while your profits are falling off a cliff isn't a sign of strength. It's a sign of a problem. It tells me they might be losing their pricing power. So where did all the profit go?
And this slide right here perfectly illustrates my point. Here is the culprit. The revenue beat is totally meaningless when your margins are in a state of collapse. Just look at the segment EBITDA margin. It cratered from 12.1% all the way down to 9.7%. That is a 240 basis point compression. That's just a fancy Wall Street way of saying their profit margin dropped by 2.4 percentage points. So for every $100 of stuff they sold, they're keeping $2.40 less in profit than they did last year. This is the source of the entire profitability problem. This is where the building is hemorrhaging money.
It absolutely is. And this confirms that the headwinds they're facing, particularly in Europe, are very real. Inflation, supply chain costs, labor, they are definitely getting squeezed. But the real question remains, is this a burst pipe that's about to flood the entire structure, or is it a leaky faucet that a good plumber can fix? To answer that, we have to go even deeper into the structure.
Okay, we've looked at the cracks in profitability and we've seen the pressure on the margins. Now it is time to check the building's actual foundation. I want you to forget about accounting profits for a second. We need to know if this business can generate cold, hard cash. Is the cash flow engine seizing up and sputtering, or is it still humming along? This right here is the ultimate truth test for any company in any industry. This number right here is the solid steel I-beam that is holding this entire structure up. For the full year 2025, LKQ generated $847 million in free cash flow. Let that sink in. That's the cash left over after all the bills are paid and all the necessary investments in the business are made. This is not some fuzzy accounting metric. This is real cash sitting in the bank, and it massively exceeded what anyone was expecting. So while the market was freaking out about a 5-cent earnings miss, the company's cash machine was quietly churning out almost $1 billion. This is the key difference between a truly broken company and one that's just navigating some serious headwinds. That's a huge number, I will give you that. It's impressive. But a giant pile of cash is only as good as the people who are in charge of it. What good is a powerful engine if the driver is steering the car right towards a cliff? So where did that $847 million actually go? Did they just light it on fire? That is always the right follow-up question. And this slide shows that the answer is disciplined, responsible capital allocation. They didn't go on some crazy spending spree. They did the opposite. They fortified their own balance sheet. They paid down over $500 million in debt in the fourth quarter alone. They made their financial position stronger. And on top of all that, they returned a combined $469 million directly to their shareholders through stock buybacks and dividends. Okay, so they're being responsible adults in the room. Paying down debt and rewarding shareholders are both good signs. It tells me that management isn't panicking. But that's what they did. I'm more interested in what they're saying. Does their story actually line up with these strong numbers? And here we have it, straight from the horse's mouth. The CEO, Justin Jude. Listen to the language, relentlessly focused on what we could control. He's openly acknowledging the headwinds. He's not trying to pretend the margin pressure doesn't exist, but he is telling you point blank that their strategy was to tune out the noise and focus on the one thing that truly guarantees long-term stability, generating cash. And that $847 million number proves he's not just blowing smoke. They executed on that plan perfectly. This demonstrates a management team that is navigating a storm by grabbing the wheel with both hands, not by cowering below deck. So let's recap. We've established the foundation is solid. The cash flow is incredibly strong. But the facade is still cracked. Profits are down. This brings us to the next and maybe most critical phase of our inspection, management's new blueprint. They know things need to change. The big question now is, are they planning a smart, value-enhancing renovation, or are they just planning a desperate fire sale to appease the market? And this is the potential game changer. The board of directors has officially launched a, quote, comprehensive review of strategic alternatives. Now that phrase is often just corporate jargon, but in this context, it's a very powerful signal. It means they are putting everything on the table. They are looking at the entire corporate structure from top to bottom and asking one simple question. Is there a better way to organize this company to unlock the value that the market clearly isn't seeing right now? This is a proactive, offensive move, not a defensive one.
All right, let's really break down this blueprint because there's a lot to unpack here. They're talking about a restructuring to save $50 million a year. That's good, standard stuff. They're looking at EV salvage, which is smart, it's forward-thinking. But the one that really jumps off the page is exploring the sale of their specialty segment. This is the part of their business that just posted 7.8% organic growth. It's their star player. So is selling off your fastest-growing division a brilliant renovation? Or is it like selling the beautiful antique furniture out of your house just to pay the electric bill? That feels a little desperate to me.
That's a very valid concern, but there's another way to look at it. It's possible the market isn't properly valuing that high-growth gem when it's buried inside the larger, slower-growth LKQ structure. So by selling it off, they might get a huge premium price that they can then use to pay down even more debt, buy back a mountain of their own undervalued stock, and laser focus on fixing the core business in Europe. It's a strategic choice to realize that value right now instead of waiting for the market to figure it out.
And this quote from the earnings call tells you exactly why they're doing this. This is the core motivation behind the entire strategic review. Management is looking at their stock price, then they're looking at their $847 million in free cash flow, and they are stating, bluntly, that the market has it wrong. They believe their company is fundamentally undervalued. This review isn't a sign of weakness, it's an act of defiance against the current market price. They are actively trying to force the market to recognize the value they see on the inside.
All right, we've seen the blueprint for the renovation. Now it's time to see if that blueprint is actually built on solid ground. We need to look at the contractor's forecast, which is the company's official guidance for 2026. This is what management realistically expects to achieve in the coming year while they execute this new plan.
Exactly. This is where the rubber meets the road. All the grand plans in the world don't mean a thing if the numbers don't back them up. Let's see if their forecast inspires any confidence at all.
Well, I'm not exactly impressed. Look at this. Organic revenue growth is basically flat. The range is between slightly negative and slightly positive. That's anemic at best. And then look at the adjusted EPS range, from $2.90 to $3.20. That's a 30-cent range. That is wide enough to drive a semi-truck through. To me, that says they don't have a ton of visibility or confidence in their own business. It signals continued uncertainty.
I see your point on the uncertainty of the range, but I'm going to push back a little. First, look at the free cash flow. They're guiding to another massive year, $700 to $850 million, so that cash engine is still running at full throttle. Second, remember that their 2025 adjusted EPS was $3.01. The midpoint of this new guidance is $3.05. So, while the range is indeed wide, their base case scenario is actually for growth and profitability over 2025, even with all these headwinds. They are forecasting a stabilization and a potential return to profit growth.
Okay, the structural inspection is officially complete. We've seen the headline damage, we've inspected the underlying numbers, we've stress-tested the cash flow foundation, and we've reviewed the renovation blueprint and the contractor's forecast. It is now time to weigh all of the evidence and to make the final iron financial call. Is this structure sound, or is it headed for ruin? Let me lay out the case for ruin, because it's a strong one. The cracks are obvious, and they are severe. We have a massive 24.4% year-over-year collapse in profitability. We have operating margins getting squeezed from every possible direction. Their own forecast for organic growth is, frankly, pathetic. This whole strategic review, while it sounds proactive, introduces a huge cloud of uncertainty. What happens if they can't sell the specialty business for a good price? What if the restructuring costs more than it saves? And all of this is happening against a backdrop of persistent, tough economic headwinds in their crucial European market. The market's fear isn't irrational, it's justified by these very real, very clear risks. But the foundation tells a completely different story. The bull case is built on solid iron. You have an incredibly powerful free cash flow engine that is just pumping out cash, proving that the underlying business model is not broken. You have a management team showing incredible discipline by using that cash to systematically reduce debt and strengthen the entire financial structure. They are returning significant capital to shareholders, which is a sign of confidence. And they are being proactive, not reactive, with a clear blueprint to unlock value. And all of this leads to the most crucial point of all. The stock price appears to be completely disconnected from these fundamental strengths. The market is pricing this company for ruin, but the foundation is screaming rebuild. So the official iron financial verdict is in. This is not a teardown. This is a renovation project. The market is making a classic mistake. It is seeing the cosmetic cracks, the earnings miss, the margin pressure, and it is assuming the entire foundation is rotten.
But our deep inspection shows that the foundation, the free cash flow, is as solid as a rock. Management has the tools, they have the blueprint, and most importantly, they have the cash to fix the cracks. For investors with the right toolkit and a time horizon longer than a single trading day, this massive market overreaction spells one thing: opportunity.
And so we leave you with this final thought. We've laid out the facts, we've laid out the risks, and we've laid out the potential reward. The ultimate question isn't really about LKQ's ability to execute this plan. The real question is about your own investment philosophy. Buying a stock like this right now is like buying a house in the middle of a major renovation. It's messy, it's uncertain, and there is construction dust everywhere.
You could get an incredible deal, or you could find out the problems are way bigger and more expensive than you ever thought once you start opening up the walls.
That's it exactly. So, do you have the conviction and the patience to invest now? Based on the strength of the foundation and the quality of the blueprint, before the renovation is complete and the fresh coat of paint is on the walls? Well, that's a question only you can answer for your own portfolio. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.